Okay, so topic of today, demand, right? We all know a little bit about demand just from our everyday lives, right? I know that when I was taking economics in high school, when I thought I wanted to be a business major, you have a graph. So this is supply, this is demand, and this isn't like pivotal to understanding trading, but if you grasp this concept, it makes it a lot easier, like not just looking for patterns on the charts, but actually knowing what's going on. So we have an equilibrium here. Let me go through and mute. So you have an equilibrium, and you'll see why all this is important. An equilibrium, right? So when there is, so less supply looks like, or we'll do demand. It doesn't really matter. Demand's easier. More demand looks like a shift to the right. So if you were to shift this to the right, the new intersection is higher, right, than the intersection here. So there's more demand in whatever market this is. It doesn't matter what it is. So this is price, then quantity. So whenever there's more demand, price increases, quantity increases. Whenever there's more supply, right? So more supply looks like a shift down. So, but I'll go over what happens when there's less demand. So increased demand leads to an increase in quantity and an increase in price, right? Less demand, a shift this way, leads to less quantity and less or a lower price, right? So you can see how shifts in demand affect price and quantity, right? And again, be patient. You'll see where this all ties in. It's important to understand the concept of it, not just looking at it on charts. So I'm going to get rid of the demand stuff or the demand discussion. Now I'll focus on supply. So with supply, if there's less supply, there's a higher price and less quantity, right? So price goes up, quantity goes down. If there's an increase in supply, there's a lower price and a higher quantity, right? So how does all this relate to trading? Well, if you think about supply and demand, you think about increased demand, right? Which is almost the same as less supply. Now, if you try to apply that to this and you move both of these graphs, it just gets confusing. So for our argument, we're just going to look at increased supply and increased demand, okay? So I just talked about how it affects price, and that's what we're going to focus on. Looking at the quantity is kind of stupid in the case of trading because you're not looking at like how many US dollars does a shift in the market. Like you don't measure that. That has nothing to do with how you trade, but looking at the price does, because we make movement or we make money off of price movements. So understanding, again, increased demand, right? And this is like the base example. So we're really going to get into the discussion and then show it on charts. So increased demand, this is the starting off equilibrium right here. There is a price and a quantity. Increased demand, right? Price in the, so it's determined by the intersection between the supply line and the demand line. So it shifts out, and what happens to price? Right? And then we'll look at an increase in supply. Because like I said, these are the two things that we're focusing on. What I showed before was just to give you guys an understanding of what all happens. So increased supply moves this from here to here. This is the original demand. I know this isn't a pretty drawing, but you can see. price goes down from the equilibrium right here. This is the equilibrium price. So if we want to make a note, increased demand equals price going up, increased supply equals price going down. Okay, so this is just a basic idea, and it's applicable with like everything in life. This is how stuff works. And that's why, in my opinion, this trading method is really good, is because it's applicable in so many situations. So now that we understand this, we'll go to the charts, okay? And we're going to talk about today demand, but I wanted to show you, for demand and supply, because it's just supply is like the inverse of demand. It just works the opposite way. But what does demand actually look like on a chart? Okay. Demand looks like this. It's consolidation that's followed by a push up, right? A push up after consolidation creates a demand area. This is an area of demand because this is where price started to truly push up after an agreed upon price region. So you can think of this as the equilibrium, right? This is the equilibrium, this whole box, the 50% specifically with how I look at it. This is the agreed upon price. The 50% of this consolidated range is the agreed upon price by buyers and sellers, because there is both buying and selling, buy and sell, buy and sell, buy and sell. So it's trading at a price here like 1.41566. It's trading at a price region where we can agree that one Great British pound is worth $1.41566, right? Now, you get these demand areas, like I said, when you push away from them. And going back to the graph, increase in demand does what? Increases price. So you can think of it as, if you really understand what demand is, you can look at it as demand causes an increase in price. Or if you're a beginner and you want to think of why this is demand, you would say price went up from this region after consolidating. So this right here must be a demand area. Now, the more appropriate way to think about it is the first way. You want to think of, or you want to be able to see the demand and then look at the effect of the demand, because we want to trade with a cause and effect relationship. That's how I always trade, cause and effect. This demand had the effect of creating a higher high, and it's demand because it produced a higher high, and also because this was a region where we agreed on price, but buyers came in and increased the value of the pound to the dollar. So there's more demand for the pound than there is for the US dollar. So we formed this area of interest. Okay. Now this is just what a basic one looks like. It doesn't look like this on the charts all the time. Now, moving on or continuing with this discussion, okay, we can see that this is just consolidation, but the best demand areas don't just have consolidation. It's more something like this. The best demand areas to play off of have consolidation, manipulation, and then some form or some break of market structure that confirms their validity, right? This push above here confirms the validity of this demand because it tells us that this had enough force to create a higher high, which means we're continuing with the trend, right? We're continuing with the uptrend, and this caused continuations to the upside. So it's a cause and effect, right? The effect is a higher high. And the thing that caused that higher high is the demand. The demand where buyers and sellers once agreed upon price, like an equilibrium here, there's an increase or a want for the pound represented by a shift up or a push up, and that automatically means price is going to increase. It seems really simple, but again, I'm covering it because if you actually get the idea of it, you don't need to look for specific chart patterns to see this stuff. You don't need to be looking at like, you know, what this pattern that happens blah, blah, blah percent of the time and holds, you know, 70%, and like breaking down the statistics. Statistics are important, but you don't want to train your eyes to see the same thing over and over again. You want to see and, you know, be able to apply these ideas. So looking at this, you want to see demand in an uptrend. So in an uptrend, demand is what's going to hold, right? That just makes sense. If you're trending up and pushing up in the markets, demand is going to be in control, not supply. When you're trending down, supply is going to hold, right? And it typically looks something like this. So using this model, we can go onto the charts and see real examples of demand. And again, it's not going to be perfect, but the best demand areas have a run on the lows, because a run on the lows is what gives us the fuel to actually push price higher. So in the real world, there isn't fuel or liquidity, obviously, that causes more demand for something, but there's almost always an event that does that, right? There's an event that increases the want or the demand for something. Like with trends today, everything is trendy, right? So things catch on quickly. So that's a catalyst to push price up because of demand, or because more people want something. And in the foreign exchange markets, it's liquidity. Liquidity is what gives us the power to make impulsive movements. And when you see a demand area that has taken lows, it's, in my opinion, more valid than an area that has not taken lows, a demand area that has not. Because what you can see, or what you might notice, is with areas like this, if you have equal lows, price will come back, run them out a little bit, and then go back up, because it's a form or an area of liquidity. But the runs on these areas don't need to be that big. The runs on these lows need to be only like a pip or two. And we'll go to the 1 minute chart and you guys will be able to see it. And I'm going to highlight examples like as I go. I'm not going to pick them out beforehand so they can be perfect or whatever. I'm going to show you like real time what's actually a demand area. So there's a question in the chat. Would you ever trade an area? Yeah, I do occasionally take trades off of demand areas that didn't necessarily take liquidity. And the reason I do that is because typically you can see if it's a really large consolidative region of price, okay? If it's just chop, 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 and you get a really strong push down before the move up, but it doesn't take any lows, that's valid. So if you see something like this, where it's chop, 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 just up and down, back and forth, you get a push up, a really strong push down, but it doesn't really run these lows. And then it goes and you get a BOS. I do like these because it tells me that the institutions had to inject sells before they bought price back up, which means that there's some sort of sponsorship within this region that should be respected. And the other thing to note is that although these aren't my favorite areas to play off of, they are still valid, because ultimately what this demand generates is a higher high. And when you generate a higher high, this becomes your higher low. So you produce a higher low right here. And when you produce that, you don't expect it to be taken out. You don't expect in an uptrend, you don't expect or anticipate higher lows being taken out, because that would make the trend a reversal. Like it would change the trend. And statistically speaking, it's more likely that a market stays with the current trend than it is that it reverses. Granted,
when you trade into higher time frame points of interest, reversals become more probable, but that doesn't necessarily mean that trends aren't more likely to continue. So with regions like this, when you don't see a sweep of the low, but you see a really strong sponsorship by institutions, you can be pretty confident that it's going to end up holding, right? So some of these areas are manipulated, like this is a manipulation of price because the institutions know that people have sell stops below here, which basically is just stop losses. So there are sell stops below here, all these lows. They know people are going to be buying, or they know that people are trailing their stops here. So they manipulate this region to take out those orders and collect more so they can push price higher. So yeah, like these areas, there is manipulation within them, and those are the best ones to play off of because they give you real fuel to push the market higher. Just like this candle here, this selling before the buying up, this is sponsorship by institutions. It's a very clear injection of volume, if you want to say that, that gives us a push up. So this gives us fuel, right? The fuel to maybe take a couple intermediary lows and then go higher. So you can be confident in something like this holding or something like this holding. But typically what you don't want to see is price when it just chop, chop, chop like this. And then just kind of starts trickling. Like if you're in an uptrend and this is your consolidative region of price, this isn't really the best because there's no true sponsorship within here. There's no immediate sell off before buying up and breaking structure. And there's also not a run on these lows. So this can turn into sometimes an area where the banks just come back to and then take it out, which means from a technical perspective that it didn't hold. Because as soon as you trade through a region after returning to it, it's invalid. So here, you wouldn't look at this as your region and this being traded through that region. That's not what it is. After you see this move, your entire region is here. So until you trade below this, this is a valid demand and it's also a higher low, but I'm focusing more on the fact that this is demand. And until you go through it, it's completely valid. So until you see this, it can come all the way down to right here and fill like a 1 minute candle and then go. But until you trade below it, it's perfectly valid to be looking at for a long position, unless you trade through it. And when you trade through it, for me, my rule is it's no longer a valid demand area. Now, that's where things can get a little tricky, like defining when it is truly invalid and when it's not. But most of the time, if I see it trade through, I'm going to be wary of the fact that it did, and I'm going to wait for a clear trend to start forming again. Like if it trades through it here and I see this, I'm not going to buy it off a pullback because demand should not be traded through if it's completely valid. That's not to say that sometimes lows aren't taken out because the banks need to take them out for more liquidity. That is true. But when you see this and you see like a breaker structure here, this is just a trick for playing off of demand. Don't assume that, oh, I traded like a little bit past it. It's still demand, so it should end up going. That's not always what happens. And the reason why is because you have to think from a logical perspective, what does this mean? This huge selling volume was put in for a reason. And if we trade below it, there's probably a reason we did. So we don't expect it to hold because the expectation is that it will. And if it gets pushed through, there's probably a reason that it got pushed through because this isn't just a little movement. And more importantly, this is the cause of a higher high. So the cause of a higher high, which had huge sponsorship, gets traded through. And why would you expect it to just hold now that it's been pushed through? Don't expect that. You want to see it trade into it. And typically with demand regions, you'll notice, and the same goes for supply, but I'm talking right now just about demand. So what you'll see is a push down, and then you'll create more demand. And again, it's really strong when you get a run of lows, when you mitigate. So when you return to these areas, that's called mitigating. And I'm sure you guys have all heard that term. This is mitigating an area, right? So it's best in any case when you get a run on the lows, because runs give you that extra fuel or grabbing orders to actually push you significantly higher. So that's a short description on what demand actually looks like. And you'll see it, you can see it on the lower time frames, the higher time frames, it really doesn't matter. But it's just consolidation before a push up. And it is back to the idea of when you get an increase in demand, right? Price will go up, quantity will go up. So when you see on the charts, when it's represented on the charts, it's an increase in price, and you think this region caused that increase of price. This is where the demand started. And that's also why I call this the origin of the higher high. This is where the demand that increased price originated from. And that's why we mark off these areas on the chart to trade back to them. And also because this is another idea. The other reason you mark up these areas is because it's inefficient price. Whenever there's an agreement between two groups, buyers and sellers, that the price should stay within here, it's consistent and stable. And this is the idea I was talking about earlier. When it's consolidating, it's consistent and it's stable. The two groups don't think that the Great British Pound is worth, relatively more than the dollar. They have a price that they stay within, or a range they stay within. The 50% is the equilibrium. So this is the equilibrium of this market here. It's the equilibrium. And when price pushes, and this isn't like the all-time equilibrium by any means, it's just for a relative period of time. This is the equilibrium of the market, and price needs to maintain equilibrium, right? The markets need to be efficient. That's why this is called an inefficient move. And demand, in the case of an uptrend, is what causes inefficient moves, because it creates an imbalance, another term that we use, an imbalance between buyers and sellers. There clearly we have more buyers here than we do sellers. So this is what caused it, and we need to come back to this, or the market makers need to come back to this to balance price back out, because if they don't, the markets aren't efficient. There's not a balance between buyers and sellers, and there needs to be, right? Circling back to the idea of an equilibrium. Whenever price moves up, there's a new equilibrium, quantity and price. So demand goes up, new equilibrium is here and here, and it stabilizes out. But in the case of this market, or the foreign exchange markets, unlike most real world examples, is it needs to be balanced out consistently. And so this is the idea of it, not just showing you stuff. I mean, yes, I'm showing you what it looks like, but I want you guys to understand, and drop in the chat if you get what I'm saying with price needing to be balanced out. And I don't do all the fancy equilibrium when I trade. I just mark off the demand area that caused a higher high, or caused a push up, cause and effect relationship. I mark that up and know that price needs to come back down to there so we can balance out the buyers and the sellers, right? So I hope that all makes sense. That's the concept of it. And then I will show you some chart examples. If anybody has any questions, drop them so this can be interactive. I'm going to wait a minute, and I'm just going to talk about quickly why it's important to understand it like this. It's like math. You can have people, you just tell them something over and over and over, and then you give them a test and they're just clueless because they don't actually get it. Like actually understanding why something is the way it is super important. Like factoring, people don't actually get factoring. They're just told how to factor. So when they get an example that isn't perfect, they have no clue what to do because they've only been shown one way. That's a problem with trading. People are only shown something one way. So they'll get this picture in their head, which is good to have because this is what demand looks like. Actually, this is a really good representation of it on a chart. It's consolidation and then a run or a push higher because there's clearly more buyers, right? Injecting volumes to push price up. There's a higher or greater demand. So, but people get this picture in their head and then they don't know how to apply it. But with the Forex markets, the charts will like never look the same. So if you just try to take every trade based off of something you've seen before, it doesn't work because they don't look the same ever. And that's a huge idea in a book called Trading in the Zone, or I'm almost certain that's what it is, but there are a few books that talk about that. Every moment is unique and you can't expect it to look the same. So understanding the concept is really, really important. And yeah, like this idea applies on all time frames. Demand is applicable on the 4 hour, the daily, the monthly, the weekly, the 1 minute, the 10-second. Like you can trade it on literally any time frame you want. So I'm going to talk about demand, and then if I see a really good example of supply, I'm going to invert my scale to show you that, because supply is literally inverted demand. So again, any questions on this? Do I need to clear anything up, or did the discussion of tying this back to like the real world kind of make sense, and you guys can see what it looks like and which areas of demand are strong? Again, areas that are strong, really big, sell to buy, right? Really big, sell to buy areas. Strong because institutional sponsorship caused this move up after this consolidated period. This is demand. And then when we run the lows, that's also very strong because we take liquidity and have enough orders to push the market much higher with true volume, true sponsorship. Okay, so that all made sense. One person for it making sense.
So at the top here, are you saying that like this right here, like it making that, would that be the, like, would you say up there, like it broke, it tapped into equal high liquidity and then it tapped into equal low liquidity? Because I feel like this like makes sense as far as like it purged equal low liquidity, but as far as the one at the top, I'm trying to like figure out how to translate that. Like, does that make sense?
Yeah, so like you're asking like running the high and then like coming back to the lows and then going.
Yeah, I guess versus like then breaking the lows, because like I guess like if you didn't put that dot right there, I would have been like, well, we broke this low and then this low, so are we still bullish? You know, but I guess like, because you know, like I noticed y'all said intermediate lows and intermediate highs, and I'm seeing now why, like, when it comes to structure, I can see why people are kind of confused sometimes, because like where do you get, like, how do you get the discernment of knowing this is intermediary or intermediate versus no, like this is like this is the part of the structure that's actually like the bigger part? Because my understanding here of the first, of the one at the top, is that because you haven't created any significant lower lows, then you're still bullish, even though you broke those intermittent those little baby higher lows. Yeah, right, exactly. Yeah, thank you for following me with that. Yeah, and I definitely get that break of structure, but I guess for me it's just like, at this point, are we just sitting in our hands and waiting and observing to then anticipate being able to hop back in the trade when it comes down here and does whatever it wants to do and then go up?
Yes. Yeah.
Okay.
Exactly.
Because my thing, exactly. Yeah. Because my thing is, I really appreciate you saying, like, you know, the market's like a snowflake. You know, the market is like a math equation where you might not get the same numbers, but the equation is the same. If I give you different numbers, will you be able to be like, you know, would you be able to compute it? And so that's why I guess like I'm trying to figure out the thought process between looking at this area and this like here saying, okay, the reason why I'm gonna sit on my hands and wait for a price to get back to this area. Granted that what I have circled would be like foreshadowing. That's kind of how I have in my head. Like these areas are simply foreshadowers, right? Yeah, exactly.
Yeah.
But for the one at the bottom, I feel like I guess the bottom is a little bit easier to like understand than the top one.
Yeah.
Because yeah, exactly. You see, okay, you see that this little thing, this line that you have like right here. That is the reason why sometimes like I'm kind of confused when y'all talk about intermediary lows, because my thing is I don't want to count out a real low and mistake it for intermediary, and then me thinking that, oh, I saw breaker structure. Did I really see breaker structure? Because it's like, how are we differentiating between the baby lows versus like the big lows and big highs and stuff?
Yeah, so like that's a good question, and it's important to understand it. And I was going to talk about a little bit more about it before I moved on, but yeah, like this, so these areas are like precursors to what price is going to do. You don't necessarily want to be trading within these areas when you see consolidation, because for the most part, you're told to stay out of consolidation. When you can't discern a trend or detect a trend, you don't trade. Like you should be trading in markets that are clearly moving in one direction or the other. So for today's discussion, it's moving up because we're talking about demand. But with something like this is easier because, or in my opinion, you can see like this was clearly created to attack these lows and grab orders here, right? This had a clear purpose to attack these equal lows and give us the fuel to push higher, right? So
Right.
you don't want to be necessarily trading in this because it's going to be represented by just back and forth, up and down. And you don't want to be trading back and forth, up and down, doing this, because when you trade up and down movements, you're just going to get stopped out. But what they create on the higher time frames or for the bigger picture is they create actual movements that you wait on, right? You wait for the retracement back to get in. Like you said, you wait for this move to come back to here and then mitigate out of this demand. And we need to mitigate out of this, or mitigate this demand area, because this is what caused price to push up significantly. And this is where the imbalance in this market started, because there were more buyers than there were sellers within this leg. And what caused this leg, looking at that cause and effect relationship, this demand caused this leg, which created the higher high. So you need to come back. But yeah, and with something like this, not getting confused, typically what you'll see is, like I said, this is an example that you don't like, where it's just like chop, 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 and then it just starts to trickle up. Like you don't want to see it just trickle up. So what I'm referring to in this is a really impulsive move down followed by a move up. And it's easy to see on the charts. What I'm saying is, like, you retrace and then you just like start doing this. Like that's not really what you'd like to see, because yes, these are equal lows, which granted they're equal lows here. These are equal lows, but you don't have any sponsorship that came into the market that caused you to really push away, like a sell and then a buy up, right? You don't get that here. It's just trickle, trickle, trickle. But in this case, this was engineered to take a little bit of liquidity in an impulsive manner. And when you see runs of liquidity, it's almost always an impulsive movement. In the case of demand to the downside, it's an impulsive push down and an immediate push back to the upside. So when you see a violent move that causes you to push away, that's good. When you see just chopping and you start to move away, that's bad. And that's what you want to avoid with equal lows. So that's the difference. But this is my favorite. And this is what we'll focus on, because this is more valid and
it just makes more logical sense as to why it works.
Mhm.
So
Have you found a way to like see, I guess, or study like what pairs look more like that right there, like how they move? Because I remember you were saying like certain pairs that kind of have like a personality. And so like, do you think there's a way for us to figure out like what pairs, like, okay, for example, like you said, like I like moves like this too. Like I love this. Is there a way for me to figure out what pairs more so like communicate to us in this way? Or
yeah, like so I'm gonna answer one more question and we wait for BOS at the demand to get in on the retracement. Yeah, so with that, when you see demand, you want to see a break of structure. So an easy way, and I'll get back to your question about pairs moving like this more than others, but the question that I'm answering now ties in nicely, because what I was going to describe demand as is it's consolidate. Okay. Consolidate, manipulate, BOS. So this is how I look for demand areas, and it's easy to remember because it rhymes. Consolidate, manipulate, BOS. So consolidation, manipulation of the lows, and then a break of structure. Now the first break of structure can be like here. And then, so this is like a minor break. And honestly, with ones that sweep the lows, and that's all I'm really going to address, because that's what I like. I usually don't take a demand area if it didn't run lows. So when you get this BOS, you can play off of it like that if you want, or to confirm it, which is usually better, you wait for a major break of structure. And again, I've said this a lot, but most people don't think of this push higher as a break of structure because you're tuned or taught to think only of this as a break of structure, like this here, break for a reversal. But that's not true. This is still a break of structure. It's a break to the upside that causes a continuation with the general direction or with the trend. So consolidate, manipulate, BOS. This is major, and you typically want to see this before entering. Now, the other thing I want to say, so I'm going to clear all this because I've given you guys examples of it, and I'm going to draw it again. But what you'll see, especially on like the 1 minute with pairs like Euro USD and GBP USD, is let's say you get a leg, and then you're like right here, and you start to do this. This usually holds on pairs like EU and GU. And EU and GU are pairs that move more like this because they're the most traded pairs, or at least EU is for a fact. It's the most traded pair. So guess what? It's the most manipulated pair. If the banks know it, everyone is going to try to trade it with retail methods. They're just going to manipulate the crap out of it, right? That's not surprising. So they know people are trading it. They know that people are using retail methods. Retail methods work based off support and resistance, which for us is just the creation of equal highs and lows or liquidity. And we run them, especially on EU, like all the time. All morning you can sit and watch it happen. But it doesn't, so me showing this is important because this isn't really a pullback, but you can join in on this move right here and still make money because it's just textbook demand. Like you can play off a textbook demand if you have a direction and you know where you're going or what you're doing. So you can see that lows, swept, and then go, right? You broke structure here. So BOS, and then we test. So for me, how does it fit the schema or the scheme? Consolidate, manipulate, BOS, test, and go, right? You guys can see that. So yeah, Aaron said I do Asian breakout on London. Yeah. So like you can, it's just manipulation, but most people will see it and they're like, oh, that's manipulation, but it creates areas of supply and demand. So like we can look now at the charts. This is crazy, but you can see demand areas like this. And this is going to seem like a stretch, but like if you really, really look and think about, like, picture the lower time frames, because I trade on like the 1 minute. If you picture the lower time frames and just think about what they're doing, look at this. You can see this. And now if I had the 10-second chart, it would be easier, obviously, but imagine or look, because this isn't imagination. This is something that a lot of really good traders talk about. Looking at wicks, you can see what's happening on the lower time frames just by looking at wicks. Like you could pick up hourly price action by looking at wicks on the daily. You see these wicks, right? This is up, right? Here's an up candle. Here's a doji. Now, dojis, we know, just conventionally mean indecision, which is consolidation. So we have equal lows, consolidation, manipulation, and then we get our break right here. This is a break of structure with this push up. Once we see these candles close above, right? This is a break of structure. Here's your consolidation. And like I said, think about it on the lower time frames. This is an up close. This is sideways movement because it's up and then down. So consolidation, we create equal lows, we run them out, we break structure. So now this whole area is demand within here. And that's what price comes to test. And sometimes, or quite often, with really large wicks, if I were to put this here, you would be able to see a test of this wick. But this is the whole demand, I guess, box, quote unquote. And then what do? You trade back down into it, right? And then here you created a higher high. Now here's the other thing. And I actually caught a trade off of this morning. This is super risky, so I did not send it out. We had equal highs. Now this is demand as well, right? So demand, like I said, looks like consolidation, manipulation, break a structure to come test. Now this here, within this wick, wicks are areas of demand on the lower time frames because wicks will contain stuff. Within this wick, there is probably a series of 5-second candles that look like this, right? So the wicks contain or are demand areas, which I'm going to cover a little bit more so you guys understand it. But you can see this is an example like what I was talking about, where you get a push up, a retracement, consolidation, push up, and then you need to come back. In areas like this, they do work. Are they my favorite? No. But when I can see that the last move or before this move up, in this case of an uptrend, is a sell to buy, it validates it for me. So these areas, and that's like the example where I made it very clear what I was trying to say. When you see this and you see a sell to buy, that helps. When you see consolidation, a sell to buy is your last candle before the up move. That's a strong area. And that's what we had here. You can see we chopped around on the lower time frames. We chopped around, okay? And the other reason this is a good area for me is because it mitigated this last area of demand. So right here, right here, we had demand. For me, it's from this wick to the sell to buy. And then look at what price traded into. My entry was literally right here at this wick. And what do you guys notice? It creates an area of inefficiency because it's a quick and explosive push away.
we get a lot of demand within here. This is a sell to buy candle, and that makes it, for me, it automatically makes it a really strong area of interest. Now, I'm not going to sit here and tell you that I did this because this is absurd. Some people do trade like that. I don't. I don't like trading like that. I did it like this. It was pretty much a 1 to 4, and I'm just targeting equal highs, right? So you guys can see this, and it's especially good when you find areas of demand like that, where you get really, a really clear mitigation from one area to the next. And if we go look back, like I said, I didn't nitpick examples, but you can go on the charts and find it all day. Like EU the other day had a ton of stuff on it. It was just the easiest continuation trade. Like you could have done this all day. And I actually sent this trade out. So you can see here that we're just trending up, super clear. Up, 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 right? And I highlighted this in another video, but I want to go over it again because it was just so easy, right? I'm not going to get into the logic of why I decided to buy it when it was already trending like this. But what you guys can see is this is consolidation because we have a bunch of candles in a really tight range, right? Consolidation. We have relatively equal lows. They're not perfectly equal lows, but we have relatively equal lows right here. So consolidate, manipulate, BOS, and then a test. Now, where is your actual demand? For me, it's the last selling candle before the buying up. So my entry was right here. And for me, it was a 1 to like 9.8. So I'm just going to drag it up. My TP was at like 1.178 because that's a bank level. I don't necessarily use bank levels every time I trade, but they can be helpful. So you guys see that? Consolidate within an uptrend, consolidation, chop, 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 chop. And on the lower time frames, this is where it's a little more obvious. You can see it's just down, up, right? Down, up. And then we took this high. Then we took the low, the lows, doesn't matter how you look at it. We also took this singular wick low, and then we broke structure here. I'll label that as BOS. So just remember when you're trying to trade demand, consolidate, manipulate, BOS, and test. Consolidate, manipulate, break a structure, and test, right? That's what it happens pretty much all day, especially on the majors. Now look again, right? Here, this demand created this high. This is demand as well, okay? Because it's consolidation, and then we get sell, buy back up. So consolidate. This one didn't really have the manipulate, but consolidate, BOS, come back and test. Now the whole area that you would mark off is where the consolidation is. And for me, it starts here and goes to here because look at what price was doing. Down, right? No movement, up, down, up. Where do you really start to move away? You start to move away here. This is where your imbalanced move is. So this is the demand that caused it. And usually you can see areas of demand by looking at imbalances. Like where you see imbalance, it's usually caused by demand. Like this imbalance within here was caused by this demand. This imbalance was caused by this demand. Now here, we consolidate within here. And then what happens on the lower time frames? Like think of it in a really fractal manner, guys. So we consolidate all within here. Now we run these lows. So you can think of it like this. So up, down, up, run the lows, right? And then where's our BOS? The significant, like pertinent break of structure is right here. So here's our BOS. And then we come back to test the region. Now, the demand, the initial demand was down here. That's true. But what really caused this move up, that's how you find the best demand areas, is looking like what move or what area actually caused this imbalance move up that created the higher high. It was this area of demand. So you can mark it up if you want to, like this whole thing. That's completely valid. So you trade into it and then you head back up. But for me, how I look at it, again, thinking about things in a very fractal nature, this is a doji. So this is down, up, and then within this wick, down, and then up, down, right? Up, up, down a little bit. And then what do we have? It takes a lot of practice to think like this, but it's really important to be able to, because I don't have the 10-second time frame. If I did, this would be pretty clear. But you can see also, this is the move down that really caused the push up. And then here, this is the low. So this is on a very fractal or smaller time frame. Here's consolidation. Now you can think of the manipulation of these lows with this push here. Or if you're really getting down to it, you can think of these lows, consolidation, manipulation. Here's one BOS. Here's the pertinent BOS here. Here's an imbalanced move, which validates that this was a strong area of demand. So if you wanted to refine it and not have such a huge area, like I showed you guys before, you can draw this right here. And then what do? We come test it to push higher. And this is where the really, really strong move ended up happening after the test of this demand. And you guys can see it's just following structure. It's higher highs and higher lows, trading it with demand. And you can also see it here, right? Here's our counter trend. Here's a break, right? And now what is this? This is down, up, right? Up again. So if you break it down even more, it's down, push up, push back down, right? Up, down, up, down. This ran out these lows by like a pipette. So this is an area of demand and you get a break of structure right here. You come back and test it to go higher. So if you had taken all these, and I did not take all of them, I was happy with having a 1 to 10 running. I was also busy at the time, so I wasn't going to sit and stare when I had other stuff to do. But if you had taken this up to the target area right here, and you had every trade going that you could have, you would have banked an absurd amount.
Wait, how did you determine that first target area? Not including like hindsight. Like I see why, like where would it capped off like at the start of that imbalance on the right side. But if we didn't have, like, if none of this over here happened, how would we know that this is a good place to like get out the trade?
Yeah, so I'll go over that in a second. But you guys can see it's just like that day was just entry after entry. And I know one of our members caught like most of these moves because I was watching it and kind of keeping him updated. But this is just 10, 7, 6, 5. So there's a ton of RR here. And the reason, so demand's in control, so I don't want to be selling, which is why I wasn't at all looking at selling. But 1.178 is an institutional level. If I go back, I don't know if it'll let me on the 1 minute.
Oh, you do the 8s and not the 5s, or?
Yeah, like I do 20, 50, and then 80.
Oh,
It's
do
just,
you feel that's, that's so interesting because my friend was saying that he does that too. Because when I started learning about levels, I started off with doing 25, 50, 75. Do you find that like one is better than the other, or does it depend on the pair, or just like a rule of thumb, like should I switch it to the 80-20 versus like sticking to the 75-25?
I mean, it doesn't matter a ton, like especially on volatile pairs, but for me, the 80 works better. It's just cleaner, honestly. So that's why I use the 80. But the reason I took supply, or not supply, the reason I took my trade off the table here is because of this supply right here. So this is, and I'm actually going to invert this so it looks like demand, but you can see chop, 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 run the high, BOS here, and now this is untested. And then here's your last up move before the down move. So that's supply. I'm going to invert it so it looks like demand, and you'll see what I'm saying. Like now this looks like demand, right? Lows, consolidate, manipulate, BOS. You can tell it's a strong region of demand because of the imbalance. And then you come back to it. And in this case, it just blew straight through it. But honestly, the reason, so it getting just murked doesn't mean it's not strong, right? It's because we're in a downtrend. And when we're in a downtrend like this, don't expect demand to hold because supply is in control. And you can see that, or you can validate that this was a strong level here, because look at how impulsive the push through it was. Like we had so many orders over here, but now we're in a downtrend, but we had so many orders over here that price is kind of more or less, I mean, this is by no means trickling, but we're getting wicks, indecision, little candle, little candle, little candle, and then boom, just crashes straight through it. It's because this was an important area that had a lot of orders and validity in the market. And it just didn't hold because of the trend, but you can see it's a clear level of demand. In this case, since I inverted it, supply technically, but consolidate, manipulate, BOS, and then you want to see a test. So now I'm going to flip this back around and we can look for a couple more examples of demand. We're almost to our hour. So I'm going to, like I said, I'm going to stop recording it an hour, but you guys can see, like, here's a clear example of demand, except this is what I was going over, I think. And now I'm just on a different time frame. See what time. Actually, no, this is not. So you guys can see.
Is it proper risk management to be trading like the mitigation trading style that you're talking about earlier?
Say that again.
Like what you're showing now, where you're seeing a demand zone and it's in an uptrend.
Yeah.
Is it okay in risk management terms to trade like that?
Yeah, definitely. So like within here, this, excluding this wick, this is just a lot of consolidation, and like this is just mitigation after mitigation. Like here's an area of demand, right? And this one was actually pretty strong because we had all these lows. And I know this isn't like how I'm showing you guys. I'm going to zoom in and show you guys exactly how I've been referring to it. But you can see consolidate. Look at all those wicks. Manipulate. Now here's a BOS. And then here on like the 2 minute, which I was looking at this. I didn't end up taking this. I ended up taking stuff within here. But this was a break of structure. So minor break, major break, consolidate, manipulate, test, and go, right? So now you can see with this price action all within here right before this big move. And I actually caught this was, I think, like CPI or something. I can't remember. I caught the move on GU, so that'll be the last thing I talk about. But you can see consolidation. We have all these lows. Consolidate. Now we have this spike, but look at what happened to this spike. Consolidate, manipulate. Here's a break above, right? Why is this a good region? Well, for two reasons. It's like a combination of the two that I talked about. So this ran the low, but it's also a very strong sell to buy. So ran the low, sell to buy, BOS. Now we need to test to go higher. Test at the open of it. Stop loss below. I don't even know where your targets would have been. Doesn't really matter. You could have just put it at like this high right here. That was a 1 to 2, but it ended up running for way more than that. But you guys can see that this was all just following demand and structure. Like structure is really in an uptrend. If you think about it, it's created by demand, because when you get this higher low, what's usually within this is demand. When you get this higher low, there's demand. So that's why when you see good areas of demand, you also see that you're trending strongly, because these areas actually give price the strength to go higher for the exact reason that I talked about in the very beginning of this recording. So when you see good demand areas being respected and mitigated, like a mitigation train, like here, boom, mitigate, boom, mitigate, boom, mitigate, you get that nice flow. And then you usually get really strong reactions off that. And like, there's also demand in here. You can see consolidation, lows, 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 manipulation. And now here's an example of what I'm saying. So consolidate, manipulate, minor BOS, major break when you close above this. Now let's enter at the wick. So let's say this is like not a particularly planned out trade. You enter at the wick and you want to target this high because we're in an uptrend and we know that these highs function as liquidity. So let's just say we enter right here. It looks like it ends up getting stopped out, but you can see it mitigates right at the wick because there's stuff contained within this. There's consolidation, manipulation, break a structure, and test. At its peak, it got up like a 1 to 10, and it was on the 1 minute time frame with like a 1 pip stop. You guys can see the power of this stuff, right? So this is the idea of stuff being contained within wicks. And actually, it's funny. Look at what price came back to. If I adjust this, I can't adjust it anymore. Look at what price did. This was technically never mitigated. So if you entered it this wick, put your stop below, barely went past it, but you can see like price likes to mitigate these wicks because they have, okay, someone raised their hand. So you can see how this all works, right? Consolidation, manipulation, break a structure, go. Consolidate on the lower time frames, down, up, run the low, come back, test, and go. So that's all I'm going to talk about with the demand. I'm going to end the recording here, but I'm going to talk for a couple more minutes and I'll answer some questions. So I hope you guys enjoyed this recording and this video.